All right, great day, Gadfly subscribers. Want to thank you for joining today to a Gadfly interview. Very excited today to be joined by Simon Mikhailovich, and Simon's work can be found over on his Twitter handle. He's at S_Mikhailovich, and that's spelled Mikhailovich. And I do have in the comment section, you can take a look and see his actual link to his Twitter handle. And you can also follow his work over at the bullionreserve.com. And those links can be found in there. And then also joining us is Paul, London Paul of the SeriesReport.com. And gentlemen, great day. Welcome to the Gadfly.
Thank you.
Thank you. Wonderful to be here again.
Absolutely. And Paul always has great ideas in terms of interviews and guests. We were talking before we went live just in regards to really documenting in terms of where we were in terms of the economic climate and, moving that forward to today. So, Paul, I'm going to turn it over to you so that you can start the discussion.
Yeah, well, obviously, good morning, good afternoon, good evening to all our subscribers and everyone who's listening live. For me, it's a wonderful occasion to have Simon to do this interview, and for me to not be the person being interviewed. For me, I've known Simon for a relatively short period of time. We've had some wonderful discussions. I really appreciate his very erudite way of looking at things. He's very measured in how he approaches things, and he has a wonderful sort of broad experience and understanding, which I think it'd be wonderful to share with our subscribers and to a wider audience. Now, obviously, everyone's focusing on things that are currently happening now and have happened since 2008 and maybe to the .com era, and some people go back even further than that. But what we thought it'd be a really great idea to do today is to actually put a lot more historical context, go back, over 100 years and understand why we are where we are today. And I think Simon's the perfect person to be able to do this for us, and it will give people a lot of understanding as to, okay, now I understand why things are happening, why things happened in 2008, what happened, maybe going back to the .com era and fast forward to 2020. And with that, obviously, welcome, Simon, and thank you very much for doing this interview. It's a real pleasure.
Thank you very much for having me, Paul. Great to be here.
Well, likewise. I mean, and I'm sure it'll be a wonderful interview and for people to gain a huge amount of insight into things they perhaps don't really have any understanding of necessarily. So I guess the question is, where would you like to start?
Well, maybe I can tell you a little bit about myself so that people who are listening can understand where some of the thinking and some of the conclusions that I derive are coming from. I was born in the Soviet Union, grew up in St. Petersburg, emigrated with my parents and two grandparents in 1978. I was 19 years old to the United States. We were allowed to take $100 a person in cash and a suitcase each. So I have some experience with repression, political, financial, and otherwise. Ended up in the United States, in Maryland, and basically spent the last 35, 36 years in the asset management business, of which about 16 or 17 years was running my own hedge fund firm with a couple of partners that was focused on structured credit. This was from 98 through 2014. Structured credit, CLOs, CDOs, credit derivatives. So we were on the cutting edge of that securitization technology and pretty quickly discovered that how pernicious it was and got on the right side of it, basically distressed, mispricing, playing various strategies with taking advantage of the inefficiencies of that market, culminating in it's called Big Short. I would call our version of it was a moderate short trade in 2008, leading into 2007, 2009, then reflation, buying mortgages at pennies on the dollar, but the subprime mortgages, and running that through 2014. And then I got to do what I'm doing now, which is gold, which basically came out of my conclusions as to the soundness of the financial system and the place in the arc, I guess, of where the system is heading at the moment, my idea of that. And so to me, so the gold was not a conviction of any sort. It was simply an answer to a question that I had, which is how does one set aside a certain amount of net worth in a format that would be impervious to the types of things that I expect, well, some of which we're seeing now and some of which we're still to see. And so we can talk about that separately, but that's basically my background and how I ended up doing what I'm doing now.
Yeah, and it's great you provide this context because it helps people understand, what you've been doing in all the years you've been here since you came from what was, of course, the Soviet Union. And like you, I kind of fell into gold more because I looked at, the prevailing economic picture, and I kind of came to the seemingly obvious realization that was the future. And I've always, from my perspective at least, said that in the end, precious metals is the obvious way forward. So yeah, I likewise share that viewpoint that it wasn't like I had any great love affair for gold for decades or anything like that. It was just more a practicality more than anything. So
it's a solution to a problem. So if one understands the problem, one starts looking for solutions. People who don't see a problem are not interested in solutions. So that's the gist of, I guess, gold and the lack of demand for it across wider swaths of Western investment community. But again, can get into that later.
Yeah, I mean, just for everyone to know, we'll discuss some of obviously the symptoms at some point, but we think it's extremely important to put the historical context first. So wherever you'd like to start with regards to that, Simon, and then we'll just see where we go with it.
Sure. Well, the reason I actually, when Paul and I spoke before this interview, we were talking about what we would like to discuss, and I sort of suggested that perhaps, just like in medical conditions, if the right diagnosis is made, or once the right diagnosis is made, then the picture of what is happening, the symptoms of this condition, and what the trajectory of this condition in the ultimate end becomes much clearer. And the interim noise of various symptoms popping up here and there becomes much less important to the overall understanding of what is transpiring and where it's heading. And so I'm not going to tell you anything you don't know. It's not like there's some secret facts that once you know them will unlock some level of understanding. What I'd like to do is very quickly just shed some light on facts that you do know and present them in a way that maybe would give you some different idea than you may have had as to how we got to where we are, which then informs in a significant way where we're heading. The other way to describe what we're doing here is, what we're observing, the facts that we're observing are symptoms of a condition or of a systemic condition. And they're sort of the what. Why are we observing these symptoms now is the why. And then what everybody's really obsessed about is not the why, but really the what, the when, and the how. Meaning, like, what does this mean? Where is this going to go? How is this going to all evolve? But using just the symptoms to define that is much harder than just taking a step back and understanding the general arc of what's going on. So very quickly, nothing that's happening hasn't happened before, either in the United States or in other countries. It just hasn't happened in our lifetime. And so therefore, people, don't have necessarily the gut feel for the context within which this is all happening. I have a little bit more of a gut feel because I've lived in the Soviet Union and I've watched very closely the arc of that system. I'm not comparing the Soviet Union to the United States directly, but there's a certain historical pattern which all empires follow from their rise to their apex and to their fall. And of course, the Soviet Union went through a similar type of development in its own way. And this is what the opening line of Anna Karenina, Tolstoy's Anna Karenina, means when he says, all happy families are alike, every unhappy family is unhappy in its own way. Meaning that, success is uniform, failure typically has specific circumstances, but in the end, it is what it is. And, at the end of unhappy families, a divorce, all the same, even though the details of how people get there are different. So with that in mind, first of all, what is a free enterprise system? What is a free market system? In a free market system, basically, is a system where prices are the most important signals that are determined in a free market based on supply and demand. Well, clearly, what we're observing now is not that. The price system, of course, the most important price system in any economic system is the cost of funds, because that determines how projects are funded. And if that system is not determined by supply and demand, but rather by the government, then we are in a completely different system. So whoever thinks we're in a free enterprise system, we really are not and haven't been in a while. And that has to do with a very natural, again, human and societal arc that is all familiar to all of us, because when we're young and we have people who are young and have little to lose are much more interested in taking risks. As people get older and maybe built up some savings, the risk-reward equation switches to where the risk becomes less welcome, and people are more focused on protecting what they have as opposed to acquiring additional wealth. And it happens to systems as well. So up until 1907, the panic of 1907 in the United States, the United States was operating under a very harsh, pure capitalist system with a gold standard. So hard money, prices haven't changed in decades and decades and decades. There were many crashes, there were many depressions. They were all very short and acute, essentially like brush fires in the forest, clearing out the brush constantly. And that is the system that was responsible for the great surge of the United States as an economy, as a country, from its beginnings at the end of the 18th century and through the 19th century. By 1907, the country became very wealthy. And of course, the priorities, as I just described, started switching from protecting what we already have to gaining more at any cost. And so when financial panic happened in 1907, JP Morgan collected the top bankers in New York. There's a famous story in his library here in New York City, and held them hostage there until they agreed to bail out the system. That was the first, I don't know, some people who know history may challenge that, but I think that was the first major systemic bailout. That bailout was done from within the system, basically from within the financial system, not from the government side, because the government didn't have the capability to do that. But that was the first, so that we set ourselves on a different path there, where the free enterprise system, whereby success is rewarded and you can get to keep the fruits of your success, and then failure is punished by you losing your money, was replaced by too big to fail concept, that all of a sudden, the failure would be too painful. We don't want to lose the money, and so we're going to do something about it. That event directly led to the creation of the Federal Reserve in 1913, which was essentially a government-related, not directly owned, but government-related central bank, who was responsible for becoming the great equalizer and engine directing sort of the price of money, the economy, monetary policy, and so forth. So that was the first step on the road at the end of which we now find ourselves. The next big leap forward in that progression was the Great Depression of the 1930s, where the too big to fail concept taken sort of another step, and the New Deal essentially dispensed with a lot of free market principles. Now, a lot of people don't see it that way in retrospect, but everybody should ask themselves, how did Ayn Rand, anybody who's read Ayn Rand at Le Shrug and was surprised, particularly if you reread it recently, if you've read it before, or if you read it now, having never read it before, you would be appalled by the similarities and by, not directly, but by a lot of themes that she picked up in the mid-50s. That is very strange. Like, how would she know that we're heading there? well, having grown up in Russia and having escaped there in the 1920s after the revolution, she recognized correctly what was happening in the 1930s, and she saw that that was a step in the socialist direction, a major step in the socialist direction. There's also a chart that I have that I think is very telling. It shows the percentage of the economy. I'm sorry, it shows the revenues of the US government as a percent of the GDP. And you can clearly see on that chart that from 1798 or whatever until mid-30s, late 30s, the role of the US in the economy was minute. It was less than 5%. I mean, during World War I, it spiked a little bit, but then it was really minute. There was no income tax. There was only excise taxes and other taxes, but the US government did not collect income taxes. After the 1930s, after the Great Depression, the share of the economy of the US government has had leaped from less than 5% to over 20%, or about 20%, and has fluctuated around that ever since, and of course is growing significantly now. Well, that is not a free, that's not a part of the free market economy. Then in the 1940s, during the World War II, the US incurred significant debts, but in exchange for that, if you will, of course, what I'm about to say is not a political statement, and it doesn't mean anything other than just an observation of a fact. Nobody did it for that purpose. But essentially, that debt was incurred in fighting the war, the result of which was destruction of all of the American industrial competitors. So every major industrial power in the world, but for the United States, was in ruins by 1945. And so that investment that the United States made and that debt that the US government incurred, which was the highest at that time, was in a perverse way, unintentionally, was an investment in destroying the competition. Again, I'm saying it wasn't for that reason at all, but that was the result of that. And that gave the United States a massive 20-year leg up. And so when we're talking about the 50s, and going back to Ayn Rand, when I was thinking about it, so, well, 50s was the apex of American capitalism, as I was thinking about it initially. How would she get these ideas about the ultimate destruction of the system during that time? And that's simply, again, because she saw the policies and the steps that the government had taken at the time of emergency, and she extrapolated that trend correctly, as it turns out. But she was not the only one. And so the 50s and the 60s, the beginning of the 60s, were the resurgence of the American industry. We supplied everything essentially to the world. But then by mid-60s, the Japanese and the Germans and others have rebuilt their industry. It started catching up, competition arose, and we ended up in the crisis of the 1970s, which was precipitated. It started in the 60s. It was precipitated by a number of factors, some of which had to do with continuation of the policies of the 1930s, which is the Great Society, fighting the war in Vietnam, significant expenditures, brought on, sowed the seeds of massive inflation in the 70s, and essentially led to the U.S. default on its obligations in 1971, when Richard Nixon had to suspend convertibility of the dollar into gold. There's nothing ideological about it. It was simply the U.S. was running out of gold. It's like running out of money. And the way we got pressed against the wall with that was the French had realized that. Anybody who wants to understand sort of how the French saw the situation, which also would sound prophetic, there's a clip on YouTube of Charles de Gaulle speaking in the 1960s, I think, about a dollar crisis, where he very correctly describes how Americans are printing money to pay obligations with the money that they're creating out of nowhere for people who are providing to them real goods and services, which require investment of real capital, and how unfair that was. And therefore advocating gold as the fiduciary standard par excellence that has no nation, has no, sort of nobody can print it. So that was the beginning of the, I guess, trajectory on which we now sit and are coming, I guess, to its logical conclusion. So having default, so the United States essentially was running out of gold because the French, instead of accepting IOUs, have asked to be paid in gold. By the end of World War II, the United States has built the reserves of gold of about 22,000 tons. By the time Nixon closed the window, that pile had dwindled to 8,000. So they were clearly looking at the trajectory or the path of where this was going, and they saw that if the United States continued to meet its obligations in gold, we would just be out of gold reserves. And so they stopped it. They thought, Nixon and Connolly, who was the Treasury Secretary, they thought that there would be a huge pushback from the world and that that would be a temporary measure that would never, pass muster. But somehow it did. This action resulted in a massive devaluation of the US dollar over the next several years. From 71 to 81, the US dollar lost 60% of its purchasing power. The stock market has gone through, I would say it was the last great bear market, which lasted for many years. Both bonds and stocks did terribly. Stocks, in nominal terms, ended that decade that I just said from 71 to 81, I think up 15%, S&P. But the value of the dollar was down 60%. So actually, stockholders lost 50% of their purchasing power if they just held the index, although it felt like they had the same amount of money. The system found its new spurt of life in the early 1980s with something called Reaganomics. Now, Reaganomics is explained in different ways, but essentially it was a system that relied on credit creation to spur economic growth. So stimulating consumption and production through credit, as opposed to through natural accretion of value through normal investment savings cycle. That is the legacy of the system that we have now. Excessive debts and the inability to generate any growth without continuously growing credit in the economy. Again, both on the production and consumption side. So we have a consumption-driven economy that is not being driven without, or can be driven, stops, as soon as the debt creation stops. Now, how did this last for so long? It lasted for so long because the inflationary 70s ended with high teens interest rates. And so when Paul Volcker in 1982 came in, who was the chairman of the Federal Reserve, and clamped down on inflation, he essentially set the dollar on some sort of a hard standard, assuring, I guess, everybody that the US government would protect the value of the dollar, at least it appeared that way. That resulted in a decline of interest rates from 18% to almost zero over the next 30 or so years. The importance of this, again, it's all very basic. The importance of this, just like when you buy a car. I mean, think about it. Anybody can buy $1 million car if the monthly payments are $1,000 or whatever, $500 a month. The price doesn't really matter as long as one can afford the monthly payments. Well, it's the same thing with accumulating debt. If the interest rates keep declining, then you can continue to borrow more and more money without increasing the debt service. And because you can refinance perpetually, in other words, nobody ever repays. There used to be people who've been in the investment business for a long time. There used to be such quaint thing as the sinking fund. In other words, when a company borrowed money, issued a bond, it would immediately set up a sinking fund, which is a cash account where it would set aside a portion of its profits going forward that bondholders would look to get repaid at the end of 5, 10, or whatever years. Nobody knows what that is anymore, and no company has it or has had it for a very long time, because essentially no debts are ever paid off. They are refinanced. In fact, they're refinanced, rolling in the interest due. So you can do that. You can keep borrowing more and more as long as the cost of funding goes down and down and down. So you can pay the same amount, owe a lot more money, but it doesn't feel like that because the cost of carrying this debt is not rising. That has gone on through 2008. And what happened in 2008 is the interest rates dropped to zero, essentially, or very close to zero, very low. And from that point forward, we have set on a different path where every additional dollar of debt started costing additional debt payment. But because the interest rates were so low, this incremental additional cost was initially not material. But as time goes by, you can appreciate that even if at 1%, and if the rates, let's say, stay at 1% perpetually, if you double the debt, you will then double the debt service, however low it is. And if you quadruple the debt, you would quadruple the debt service, however low that is. And so we have been in that sort of situation where, for the past 10 years, 12 years, whatever it is, when the rates have been pinned to the floor and the cost of service was not so much higher that people couldn't keep borrowing money. And so this has continued. This is how we got here. So if we go back now a little bit, back up a little bit. So the 70s, we essentially blew our credit and defaulted on our obligations, soft-defaulted on our obligations. We couldn't pay back in hard money. We started meeting our obligations in soft money, which we would print. The 80s followed by, the 80s followed by, the 80s followed with the Reaganomics, which is a system of building up debt. And then something else happened. In the early 90s, those who remember, the bailout started. So this concept of too big to fail, which previously didn't really apply to private businesses, suddenly entered the picture. So people who remember the failure of Continental Illinois, the first bailout of Chrysler, and then, of course, in late 90s, the failure of long-term capital management. Those who remember that situation, it was a situation when Wall Street bailed out a hedge fund. The losses were $3 billion, and they were considered systemically ruinous. $3 billion. Just consider what happened to money and the scale of money that is happening now relative to what was happening then. So mere 23 years ago, I guess, $3 billion was about to tank the financial system. And where are we now? So the path to bailouts was set then. And so from then point forward, the 2000 recession based due to the internet bubble, the blowing of the internet bubble was met with Greenspan dropping the rates to 1%, which inflated the real estate bubble, which blew up in 2008, which then led to massive bailouts and the everything bubble in which we now find ourselves. So it's important then to understand that we are where we are, not because of something that happened 10 years ago, or 15 years ago, or 20 years ago. It's a progression. Now, the road to hell, they say, is paved with good intentions. Obviously, people, well, I don't know whether it's obvious, but I hope that people who set us on this path didn't mean to get us there. They meant to provide more safety and more stability to the system that has become wealthy. And like, again, people, successful people are more interested at some point in their life, become more interested in protecting what they have. And I'm willing to do more to protect what they have as opposed to, just at any cost, continue to build up their wealth at the cost of potentially losing everything. And so in that frame of mind, the system started moving in a very different direction from whence it started. And that's the arc that we're on. If you understand that arc, you can then also understand that it is no different from the arc of the Soviet Union, which is a system that was unsustainable from day one, but for various reasons sustained itself for about 70 years. And when it collapsed, nobody really saw it coming. I mean, my family left the Soviet Union in 78, having come to the conclusion that this was not going anywhere good. And so we decided to remove ourselves from that situation. But it came as a huge surprise 13 years later to most people. And frankly, to be honest, I mean, I was in the Soviet Union. My wife is American and she's never been. So in 1988, I took her there to show just this thing started opening up, and I wasn't scared as much as I had been before of going back. Well, neither I nor my friends there, yes, things were bad, but nobody really thought that the great Soviet Union would collapse within 36 months of when we were there. But it did, without any sort of obvious signs to that. It was on the same trajectory. It was a system that was incompatible with normal sort of economics. It was state capitalism. The control of the system was in the hands of very few people, who essentially were the 1%ers of today, or the whatever, 0.1%ers of today, who controlled everything, who garnered most benefit of the system. And the incentives for enterprise were removed. Now, we're not quite in that bad a situation, but the gist of the situation is similar, is where the state now is setting all the rates and all the prices. Nobody's allowed to fail. And of course, when nobody's allowed to fail, everybody's going to fail, because there's no such thing. I mean, capitalism without failure is like, I don't know, it's like religion without God. I mean, what is the system then all about? So it's a very different system. And the fact that the government is now trying to monetize everything against the same amount of resources, simply means that they're debasing the money. And we're seeing massive inflation, which we can talk about separately. We're not seeing massive consumer goods inflation. We're seeing massive asset inflation. Because inflation, as Milton Friedman said, is always a monetary phenomenon. So it's just a question of where the money goes. If money had gone to the people, to the regular people, we would have seen consumer goods inflation. But money went to the banks and to the asset owning classes, and so they're buying things that they're buying, which is the assets, and they too much money chasing too few goods, which in this case are financial assets. And so we're seeing massive inflation that way. And we can get into details of that. So I think it's important to understand, just like in the medical condition, the most important thing is making the right diagnosis. And if the right diagnosis is made, then of course it's important to monitor the patient tick for tick. But then whether his temperature is half a degree higher or lower becomes less important than understanding the condition that he has and the trajectory of a condition that he has based on other, on the history of how other patients have reacted to this. And just like that quote that I gave from Anna Karenina, just like with people, where every person has its own circumstances and every disease progresses somewhat differently, yet doctors have a general idea of how things work out for a particular disease or a particular condition. And so the symptoms should not be confused with the underlying condition. So when people say interest rates are zero, why are interest rates at zero? Interest rates are zero, it's a symptom of the fact that the system has reached its natural capacity for debt. The Fed cannot raise rates because the amount of debt in the system has become too high to service this debt. Because even at 1%, it's becoming too much. And so it's a symptom of the fact that Reaganomics has given rise to this credit subsidized growth model, where now it's run into its natural endgame or natural constraints. You can't keep paying for more debt. And so the rates cannot go up. But then, of course, there are other issues, demographic, which we can talk about, which accompany this whole thing, which is demographics, aging population, and the issue that is created with pension funds and the value of capital and so forth. But I think that's the historical backdrop to what's going on. I think it's important to understand. When people say this can go on for a long time, this has been going on for a very long time. We're in the final act of a very long play that developed very, very slowly. And it had good times and bad, there were good acts and bad acts in that play. But we're coming towards the end of it. And so that's why I think it's so important to have the context for how we got here, because that informs us where we are, what inning in American terms we're in this game, and what other systems have gone through and how they evolved in these types of circumstances. So then we can compare, contrast, and understand much better where this is all going. So that's my, I don't know how many minutes it was, 20, 30 minutes, brief overview of why we're here. Well,
can I say, Simon, that's the most wonderful synopsis of the last, 100 plus years of what has caused where we are today that I've heard and I've read a lot of things and listened to a lot of people, and that's why we wanted you to come on today because you've so eloquently summed it up as to why we are where we are today, and why what we're seeing today are just symptoms of a long-standing problem. And I remember, just to use the analogy, when the Berlin Wall came down, and everybody imagined that the Berlin Wall just collapsed overnight, and somehow it was this phenomenon that, and of course, it didn't collapse overnight. It'd been collapsing for decades, and it's the same principle that what we see happening today is always symptoms of a very long-standing problem, because these things don't move quickly, and there is an ebb and flow. As you said, there was periods of, well, in inverted commas, financial stability and growth, for want of a better word, and then there was the exact opposite. But we're in this final trajectory now, and maybe we can start to, because there's an awful lot of symptoms that we can discuss. So maybe we could, discuss some of these points, or pick on something specific, and then maybe look to do, further discussions where we can talk in more detail about the various symptoms, because otherwise I think we could end up talking for hours and hours, which is great, but I think for people, it's a bit too much in terms of an interview. So I guess, is there somewhere you would like to go initially with regards to the symptoms, and something that you'd like to start with there and discuss?
Well, sure. Well, I think the most obvious symptoms that we're looking at is interest rates or cost of funds, which, as I said, is the most important signal in any economy, because it determines everything. The cost of funds determines everything. And again, to make it very plain for everybody, when you go to buy a car, to lease a car, the cost of monthly payments is absolutely directly tied to the interest cost that the lease financing company can provide credit upon. I mean, it's a direct connection. And the same thing here. So whereas when you go and you look at this car versus that car, and you can buy a much fancier car in the zero interest rate environment that you would have been able to buy in a 4, 5, 6, 8% interest rate environment. It's the same with all capital projects. It's the same with companies building infrastructure projects, plowing money into building, this $1 billion condo towers around the neighborhood where I live, with basically zero or very low financing. A lot of sort of white elephants get created. It's a completely natural outcome of that, and it has happened many, many times. The problem, of course, is that every dollar of debt is somebody's asset. And so when people talk about, there's too much debt, the rates are zero, so what we need is a jubilee. Jubilee is a biblical concept where wealthy people used to lend money to the farmers, for the crops. And then every 50 years, they would wipe away those debts and start fresh. So the wealthy would just take a hit, and for the sake of the system to continue, and for the sort of not having bloodletting, that would go with defaulting all the farmers and agrarian revolts, they would sort of pacify everybody by forgiving their debts and starting again. But we are in a different system. One of the byproducts of what I've described with controlled money and the unnatural growth of demand and supply has been the financialization, because once you've had this unnatural growth of demand and supply, we have excess capacity. This is where this inflation versus deflation argument that is raging. We have excess capacity in pretty much everything. And so excess manufacturing capacity, which was built up with this borrowed money. And of course, the reason it was sustained is because the buyers also got the money to buy the goods. So the producers got this cheap credit to produce things that otherwise wouldn't be in demand. And then the buyers got credit to buy things that otherwise they wouldn't be able to afford to buy. And so we've had this unnatural symbiotic relationship between consumers and producers that's been going on for quite a while. And now it's running, particularly this virus situation, which is an exogenous shock. You can think of it as a heart attack on a patient that already has cancer. I mean, the system was already in trouble. We started having serious problems in the fall. I mean, in the early fall, in September, repo market blew up. The Fed had suddenly started to provide massive subsidies to this market very few people know about and understand. Nobody has, to date, when I say nobody, I mean nobody officially has explained what was that all about. The Fed had to restart QE, quantitative easing, also in the fall. So I think any notion that this immediate virus is causing this crisis is wrong. It's an accelerant. In the chemical terms, there's a catalyst and an accelerant. Catalyst is a chemical that facilitates reaction between chemicals that otherwise would not react with each other in the absence of this catalyst. Whereas accelerant is a chemical that speeds up reaction that's already underway. So I would say that this COVID-19 situation is an accelerant in a crisis that's already started getting underway before, and now is massively accelerated. So what we're observing here is that the rates now are, completely zero. The governments are creating extraordinary amounts of money. That does not mean that in the real economy things are fine. And so in the end, the amount of liquidity that's being flooded is floating up the markets, but it's not really affecting the actual production function and demand for goods. I mean, we can see, like in the last few days, just reading stuff. I mean, supply demand is coming back into real alignment because, for example, people are buying liquor sitting at home, so liquor prices are up, but they're not buying gasoline. Gasoline prices are down. The food prices are up. Everything else is down. So there is still these signals in the economy that are working to some extent. And as soon as we have this critical situation, we're starting to see. So the symptoms are zero interest rates, which are unsustainable for a couple of reasons. One is they destroy capital. We have an aging population. In the United States, there are 75 million baby boomers. They're altogether, I think, 80-some-5 million people of 55 and over. I'm 61, so in the next 4 years, I'll be entitled to Medicare and Medicaid. In another 6.5 years, I'll be entitled to Social Security. I was born in '59, so there's another 3 or 4 years, I guess technically 4 years behind me of baby boomers, after which all 75 million will be on government pensions. This is the first time in history, by the way, when we go into a crisis with a government pension system. I mean, until 1930s, there was no such thing as a government pension system. There just wasn't. I mean, there were government pensions for civil servants, but for the entire population, there was no such a thing. In 5 years from now, Social Security Trust Fund will be bust. Now, what does that mean? What is a Social Security Trust Fund anyway? The Social Security Trust Fund is supposedly that sinking fund that I described earlier, where the government supposedly was setting aside the money to pay the pensioners when the time came. But the way they were setting aside the money is they were essentially financing the government with that money and putting into the trust fund treasury securities. So now, starting, I think, 2 years ago, Social Security Trust Fund went cash flow negative, which means that the amount of money that it collects from payroll taxes from the existing workers have become insufficient to pay current pension obligations, which means that the trust fund has to sell treasury securities that it owns. So meaning it has to sell treasury securities at the time when the government is also trying to sell inordinate amount of treasury securities. And this trend is going to now continue until the trust fund runs out of money. Now, what happens when the trust fund runs out of money? Well, there are only a couple of things you can do. Either you need to borrow more money for the government to continue to finance it, which I think is going to be very difficult. Or you have to restructure the obligations, or you have to raise taxes on the existing workers significantly to pay for these obligations. So we're setting up for some sort of a, what do you call it? What's the word? Internecine warfare? Cross-generation warfare, I guess, where the younger people whose taxes potentially have to go up hugely are not going to stand for that. Whereas the older people would say, well, you promised me, and they don't have savings to go otherwise. So we have this brewing. This is not what I'm saying to you now is not a projection or a forecast. This is mathematical certainty. I mean, this is just the numbers. You don't need to take my word for it. You can just go and do your own research. The government has only a certain amount of resources, and the rest it has to print. So we are in for massive obligations without any visible sources of funds to meet these obligations other than just creating money out of thin air. That's the gist of it. And if nothing else facilitates this crisis towards its logical conclusion, this generational issue will. That is completely baked in the cake. These are obligations that are promised by Congress. They're legislated into the law. The government cannot abrogate them without some legal framework. And so we're heading for a confrontation, for battle royale, no matter what happens, financial battle royale. So that, to me, if nothing else tanks our system before that, this is it. So we're on a very short leash here. And of course, if the trust fund runs out in 5 years, I mean, it's already glaringly obvious. It will become ever glaringly obvious with every month and every quarter and every year that pass by. So the symptoms that I'm looking at right now that I think are the most important to look at is the fact that the United States does not seem to be able to finance its debts through capital markets externally, and the Fed is now monetizing the debts, which typically is the end game for all financial systems. The fact that the markets have completely been suspended in terms of price discovery and ability to operate based on fundamental understanding of investors as to what is going to happen. One of the Wall Street strategists, I forgot his first name, last name says Jefferies Securities, just said the other day that nothing matters, fundamentals don't matter, it's all about the Fed, what the Fed does and prints. So that's just a gambling casino in a way, where it doesn't really depend on what's actually going on. It just depends on how the casino owners issue the chips and to whom they allocate those chips, and trying to game the tables with which table is going to get the extra chips and which table is going to get better odds from the casino is essentially what's going on. And it's up to the management of the casino to decide that. So people who are the closest to the management of the casino have a better idea of which tables are rigged in their favor. It's more or less the gist of what's going on in the capital markets today. We have the pension crisis heading upon us. We have an issue of monetizing everything. So yeah, the prices of securities are going up, but they're going up in nominal dollar terms, whereas the real value of that dollar, capital dollar, is collapsing in front of our eyes. Now let me explain what I mean by that very specifically so people understand. There are two kinds of dollars. I'm using dollars. You can use pounds. You can use any currency. There's essentially two kinds of money. There's spending money, income statement money, if you will, that you spend on goods and services in real time. And then there's capital money, savings. So the value of a consumer dollar, which is what they say there's no inflation. Of course, there is inflation. It depends on your personal basket of what you're consuming. But the consumer inflation is measured based on the purchasing power of the consumer dollar. But the capital dollar, the value of that dollar is measured by the amount of future income and profit and interest and dividends that it can receive from being invested. So in plain terms, for everybody who's listening, I mean, if you these are big numbers, but I'm just using them easy to. So $1 million, let's say, could produce $50,000 income before 2008 by being invested in completely risk-free demand deposit and your savings account in your bank. Because LIBOR rate was 5.25 or something like that. Current savings account paid 5%. So you can have $1 million saved for retirement. You can retire and derive $50,000 tax-free. I'm sorry, not tax-free, risk-free income. Well, how many millions does it take today to generate $50,000 risk-free? I don't know. At 1%, it would be 5 times. 5 million to generate $50,000. That is a devaluation of capital dollar. So capital dollar has lost 80% of its purchasing power just in the past 10 years. That's what, when people say it's asset inflation, most of the people think of it as a bull market. But it's actually a bull market for the dollar that was invested 10 years ago. For the dollars being invested today, it's hyperinflation. Because the amount of dollars that's required to generate retirement income is 5, 6, 7, 8 times higher than it was just 10, 12 years ago. So those are the main symptoms that I'm looking at. And of course, again, we can't cover all of it here. But that to me is essentially, we're in the end game of the system. And that's actually how I came to gold, is by thinking through this situation and realizing that all of this has to end with the reorganization of the existing financial arrangements. Most people think of it, a lot of people think of it as Armageddon. It is absolutely no more Armageddon than a divorce. It's a traumatic change in circumstances where some people bounce from it, some people don't, but it's not the end of life as we know it. I mean, it's not the end of physical life. It's the end of a certain way of life, but there's another way of life behind it, and in some cases it may be even better and happier. But first you have to go through this tragedy, and that's kind of where we are, to my mind.
Yes, Simon, I couldn't agree more. I think with regards to what you've said and in the context of interest rates, I mean, maybe just one final point we could discuss today, if you want to comment on it, is there's all this conjecture about negative interest rates, and the Fed seems to be railing against it pretty hard for obvious reasons. Trump is, for the reasons largely only known to him, is that he wants negative interest rates because he quite simply thinks, well, we have this enormous debt. Well, if I have negative interest rates, that solves everything. But he doesn't understand the consequences of what that means. And you know, what's your views on the issue of, you know, if the Fed does subsequently go to negative interest rates, or what any comments you'd like to make on that, given we're on the discussing interest rates?
Well, you can put what you just said in the context of what I said 2 minutes ago about the devaluation of the capital dollar. Mm-hmm. So if the capital dollar, its value is determined by how much it can produce in income and profits through being invested in whatever various potential opportunities, imagine if all of a sudden it produces not positive but negative. In other words, it doesn't produce anything, it costs to own. The capital becomes costly to own, which it's insane. It's completely against everything we know that a lender has to pay the borrower to take his money. But in a perverse way, it's very understandable. It's supply and demand. There's clearly excess of dollars or whatever currency units of any currency in the world, major currency, relative to the available real economic opportunities to generate real returns. So the only way to eliminate excess inventory is to mark it down. That's what negative rates are. It's a markdown of inventory. It's inventory liquidation. Now, we haven't gotten to the liquidation stage. We're just in the markdown stage. But all inventory markdowns, when you have in normal situations, some company overproduces something for which there's no demand, first they mark it down, they mark it down, they mark it down, then they liquidate it in the end. And so, of course, just as with companies, nobody wants to liquidate it. Because particularly if you've had this inventory for a very long time, the auditors have signed off on the valuation, the management has signed off on the valuation. If you suddenly declare that it's worthless, there will be consequences from the shareholders, potentially legal consequences. Well, so how come it's now worthless? It was worth something a year ago, 3 months ago, 5 months ago. At what time did you realize that you were cooking the books? It's essentially the same discussion. So I think the negative interest rates, you can approach them from different ways. You can call them expropriation of capital, of savings, which they are. You can call them a totalitarian wet dream, because essentially in combination with digitization of money and financial assets, which, by the way, where gold comes in. See, gold is independent from the financial system. So like in the negative interest rates, or in the type of environment where this digitization and this anti-money laundering, terrorist financing regime that essentially makes movement of money very within the financial system, highly controlled and restricted, and potentially can be sequestered at any time at any suspicion of some clerk in some bank. That's where gold comes in. That's essentially what we're talking about, is how I came to gold. I realized that the financial assets, well, that inventory has to be pared down. And there are many, many different ways how that can be done. And none of them are any good for the people who have the savings. They're good for people who owe money, but they are horrible for people who own any money. So doing the right thing, you know, like the old tradition, you know, of saving your pennies and working hard, and if you do the right thing and you don't overspend, I mean, those people are about to have a comeuppance. I mean, a bad comeuppance for doing the right thing, which I think has political consequences. But okay, aside from that, so I think this is where we are, and that's why I came to gold as something that's independent, that is the only liquid financial asset that can reside outside the financial system because it's tangible. Whereas all the assets within the financial system are subject to what we're talking about right now: negative rates, haircuts, various forms of expropriation, essentially. That's to me is what negative rates are all about. And of course, yes, Trump wants it because that's what it really doesn't matter who says what. I mean, probably that's where we're heading, because there are only so many mechanisms you have to eliminate debt or to reduce it, to resize the economy. And so somebody has to lose a lot of money. I think the important thing is that money's already been lost. It's just like Bernie Madoff. You know, in the Ponzi scheme, the moment of recognition is just the final stage of what happened. I mean, these people didn't have his clients, Bernie Madoff's clients didn't have that money for many, many years. They thought they did, but they didn't. And so it's only when it became clear that they didn't, when you know, the tragedy became. But the tragedy has been there all along. I think we're in the same situation here. The tragedy is clear. It's just most people haven't fully appreciated that the value is gone. Now, of course, while the illusion persists, people can realign their positions. They can actually buy real assets with their fiat dollars. But once that realization once the moment of clarity hits the markets, I mean, that's it. I mean, in other words, it's not something that's a steady progression towards some goal. It's usually a steady progression without clarity, and then there's a moment of clarity. Just like collapse of the Soviet Union, built up for a long time, and when it collapsed, nobody saw it coming. But of course, it was perfectly logical that it would come.
Well, sorry, go on.
No, that's it.
Well, I think that's probably a good point to stop today. I think there's a lot more we can discuss and do that in the future. Obviously, we'd really like to thank you for a wonderful discussion. It's been very, very enlightening. I think it will be quite educational for a lot of people who haven't necessarily understood the historical context. And you started to now discuss, obviously, the symptoms that are manifesting themselves acutely in 2020. And there's definitely further discussion with regards to these symptoms we're now seeing. And obviously, it'll be great to get people's, or for you to give people your insight into the gold markets and you know, and allude more to obviously why you see it as you know, as a safe haven given where we are currently. So, CJ, is there anything you'd like to say, or
no, Simon,
you might like to ask Simon?
Simon, thank you so much. I think it's important that we realize what brought us to this point, primarily as we document the transition period that we're in, that we have a look back in terms of what happened, what went wrong. Hopefully we can put some plans in place that we don't make the same mistakes once again. But I think also, Simon, you said something very important and to me, and that's that this isn't the end. It's a transition period, and getting people to understand what that transition period is as we return to sound money. So a fabulous discussion, and I look forward to the second part of our discussion, Simon.
Thank you very much.
Yeah, and I'd like to say again, thank you, Simon. It was wonderful. I really appreciate you coming on. It's been very, very enlightening for people, and you know, we really appreciate your time today. Thank you very much.
Thank you for having me.
And there you have it, folks. So for our Gadfly subscribers, please continue the conversation directly in the forums. This will be a public interview, so comment directly on this, and we will definitely have Simon again. You can visit if you look in the description of this interview, you'll see the links to Simon's work and then also his Twitter handle as well. So Simon, thank you so much, and Paul, great job, and gentlemen, enjoy the rest of your day.
And likewise.